The most crucial metric for you to consider a strategy in is its win rate. After intense discussions and debates with many professional traders, we've arrived at a strategy that is, by far, the most lucrative, effective, and most importantly, so simple that even beginners can follow. Besides a high win rate, the strategy also offers a high risk to reward. So, without further ado, let's get right into it. Analysts utilize a variety of indicators for a variety of purposes. Moving average convergence and divergence, or MACD, is one of the most popular and reliable indicators. The MACD is a highly effective indicator since it can be used to trade in the market in various ways. So let's go through the principles of MACD, numerous methods to interpret it, and how to day trade using the indicator with a high win rate. What is the MACD indicator? Well, the MACD indicator shows the connection between two moving averages of an asset. It was designed primarily as a market timing tool. It's essentially made up of four different components. The first one is the MACD line, which moves relatively fast and is more sensitive to price movements. The second line is the signal line, which moves slower than the MACD line, therefore, it gives a smoother appearance. Then we have the histogram, which is simply the difference between the MACD line and the signal line. The histogram can either be rising or falling. It stays rising when the MACD line is above the signal line and falling when the MACD line is below the signal line. Finally, we have the zero line, which is simply the center of the MACD indicator. The two lines in the histogram are closely related, as the histogram is derived from these lines. If the gap between the two lines is narrow, the histogram's height will be small. And if the gap between the lines is wide, the histogram's height will be large. Trading the MACD indicator using signal crossovers. The signal crossover is the simplest technique to trade using the MACD indicator. When the fast MACD line crosses the signal line, it indicates that the market has started to show bullishness, and we can look for buying opportunities. When the MACD line crosses below the signal line, it signals the market is showing bearishness, so we could look for selling opportunities. For example, here's a chart of GBP/USD on the 1-hour time frame. We can see that the MACD line was hovering below the signal line, but later the MACD line crossed above the signal line. And if we were buying after the crossover, the trade would have made a massive profit. We know that MACD is completely based on moving averages, but we still prefer to use MACD over moving averages that are applied to the price action. Here's a quick comparison between the two indicators. In this chart, we can see that when there's a crossover between the 12 and 26-day moving averages, there's also a crossover between the MACD line and the zero line. But, according to the strategy, we need to look for a crossover between the MACD line and the signal line. Now, if we see in this example, the crossover between the MACD line and the signal line happened much before the crossover between the moving averages. In other words, the MACD crossover gave a bullish signal much before the moving average indicator did. So, undoubtedly, the MACD proves to be an earlier signal provider than the moving average. However, we do not recommend trading it solely based on the lines crossing over each other. Although this strategy works like a charm sometimes, the win rate accuracy is quite low. Here's an example where the strategy failed to work. This is the chart of AUD/USD on the 1-hour time frame. Here we can see a bullish crossover on the MACD indicator where the MACD line crosses above the signal line. So, according to the strategy, you need to buy after the crossover. But if you were buying right after the crossover, the trade would have ended up in a loss as the market continued to move lower and lower. And the reason this trade failed is that we had a contradiction between the price action and the MACD. Now, we can see that the price was trading with bearish momentum as price action was happening below the 100 EMA. But at the same time, the MACD was showing a bullish signal with an evident crossover. So, due to the indecision in the market prevailed in the direction of the overall trend, which was to the downside. So, to have a better win rate for our strategy, we'll be blending the MACD indicator's crossover technique with an exponential moving average, like the 100 EMA. By applying the 100 EMA, we would be able to understand the market's overall trend, which the MACD indicator alone doesn't provide. Now, let us understand how to interpret 100 EMA. If the price action is happening above the 100 EMA, it means that the long-term trend is up and the bulls are in control of the entire market. Conversely, if the price action is happening below the 100 EMA, it indicates that the bears are in control of the market. So, as you can see, if you want to buy from a bullish crossover on the MACD, you need to make sure that the price action is above the 100 EMA. Similarly, if you want to sell from a bearish crossover on the MACD, you need to ensure that the price action is below the 100 EMA. Now, let us see a bullish signal and a bearish signal example of this strategy on the real market. Now, this is the chart of USD CAD in the 15 minutes time frame. We can see that the MACD indicator and the 100 period EMA have been applied to the chart. Now, analyzing the chart from the left, we see that the market is trending lower and lower with the price action below the 100 EMA. But later, the price action went above the 100 EMA, indicating that the overall trend of the market has become bullish. Right after that, we can see that the MACD line has crossed over the signal line, showing a bullish crossover. Hence, this is the zone where we would want to take the buy position. And we can see that the market shot up to the upside right after we took the buy position. Now for the exits, we'll be placing our stop loss below the swing low and the take profit, 1.5 times the SL stop loss, which would give us a risk-reward ratio of at least 1 to 1.5. Now, let's take a look at another example. In this chart of Euro USD on the 15-minute time frame, we can see that the market is trading below the EMA, indicating that the sellers are in control of this market. So, as the MACD line crosses below the signal line, you can open your short positions. Again, we are going to be placing our stop loss a few pips above the swing high and the take profit at the swing low, or 1.5 times the stop loss. Note that this strategy has a great winning rate in trending markets, but fails to keep the consistency in ranging markets when the price movement is sideways. So to have a much higher probability of success using the MACD, we combine this indicator with the price action concepts. Trading the MACD indicator with price action. Now, let us discuss another strategy using the MACD, where we will be combining the MACD crossover with price action concepts to predict the markets. The basic principle of this strategy is to buy from the support or sell from the resistance. But since blindly selling from the resistance is risky and illogical, we use the MACD indicator to give us a stronger confirmation and a higher probability of success. So, for the strategy to work best, we first wait for the price to reach the support or resistance regions. And once the price action is around these levels, we closely monitor the MACD indicator for bullish or bearish crossovers. If we get a bullish crossover from the support, we take a buy position, and if we get a bearish crossover at the resistance level, we take a sell position. Now, let us look at a bearish signal and a bullish signal example using this strategy. The chart here shows that the market is under consolidation and is moving sideways. As shown here, resistance is also formed. So, to sell from the resistance, we need to wait from the crossover from the MACD line. And as the crossover happens with the price reacting from the resistance, we can open our short positions. You can place the stop loss a few pips above the resistance and the take profit at the swing lows. Later, we can see that a support is formed at the bottom, but we do not simply buy it from the support right away. Instead, we wait for the price to reverse to the upside from the support and the MACD line to cross above the signal line. Once we get a confirmation from the MACD indicator, as we can see here, you can trigger a buy position. You can place the stop loss a few pips below the resistance and the take profit at the swing highs. Generally, these setups should yield you about 1.5 risk reward. This brings us to the end of the strategy. If you enjoyed this video, you'll definitely like this next video on screen next. See you next time!